Three things just hit the market at once. First, the inflation data came in hotter than expected. Second, Supreme Court struck down a major tariff authority. And then, within hours, a new 10 to 15% global import tariff was introduced. This isn't clarity, this is complexity, so today we're not going to react. We're going to think. What does all of this actually mean for the QQQ and for the big names inside it like NVDA, Tesla, Microsoft, Apple, and Google? Let's break it down calmly, piece by piece. First, let's talk about inflation. The core PCE, the Fed's preferred inflation gauge, rose more than analysts expected. Now, why does that matter? Well, sticky inflation means interest rates may stay higher for longer. And higher rates put pressure on valuation multiples, especially for growth-heavy indexes like the QQQ. You see, QQQ isn't just a techie TF, it's a duration trade. When rates fall, the value of future earnings goes up, and QQ's multiples expand. When rates rise or just stay elevated, those multiples get squeezed. This doesn't mean QQQ is going to collapse. But it does mean that the easy phase of multiple expansion, where valuations just kept going up and up, might be behind us for now. The wind is no longer at its back. Next, let's look at tariffs and the policy whiplash we just witnessed. The Supreme Court ruled that a specific law, the IAAPL, doesn't give the president authority to impose broad tariffs. The market initially cheered this, thinking it meant relief from trade wars. But that relief was short-lived. A new 10% global tariff was introduced, and then quickly raised to 15%. So, what's the real takeaway here? It's that tariffs are not gone. The tool used to implement them has changed, but the political impulse remains strong. This means supply chains are still uncertain, business costs are still unpredictable, and policy risk is very much real. My friend Charlie would call this political optionality. They crave certainty, and right now we have the opposite. With that backdrop, let's look at the specific stocks, name by name. First up, NVDA. The company has incredibly strong AI demand and fantastic execution. No one can deny that. But it has significant global supply chain exposure, complexity around its business in China, and a valuation multiple that is highly sensitive to interest rates. It's a great business, without a doubt. But in a higher for longer rate environment, the math of the multiple starts to matter more than the exciting narrative. Next, Microsoft. This company is in a different boat. It's built on enterprise contracts, recurring revenue, and high profit margins. It's structurally more resilient and less sensitive to tariffs than a hardware company. When policy is unstable and the economic picture is murky, the market starts to place a premium on durable, predictable cash flow. That's Microsoft's strength. Then we have Apple. Apple has a heavy global manufacturing footprint, primarily in Asia. Tariffs hit a company like this much more directly than a software-focused name. Now, Apple has incredible pricing power. But even the most loyal consumer has a budget. The risk of margin pressure from rising costs is significantly higher here than it is for Microsoft. What about Google? Its business is primarily driven by advertising. This means it has less direct exposure to tariffs on physical goods. However, its fate is more tied to the overall macroeconomic growth cycle. If sticky inflation and high rates eventually slow down the economy, advertising budgets are often one of the first things to get cut. So, while its supply chain risk is lower, its cyclical risk is something to watch. Finally, Tesla. Tesla is at the crossroads of all these issues. It has a complex global supply chain. Its auto sector profit margins are very sensitive to input costs, and demand for its cars is sensitive to financing rates. Higher interest rates and tariff uncertainty create a recipe for more volatility here. In this kind of environment, Tesla starts to behave more like a cyclical industrial company. So what does this all mean for the QQ index? QQQ is heavily concentrated in exactly these names. So the index as a whole faces a triple threat: sensitivity to interest rates, sensitivity to global trade policy, and the risk that comes from having so much of its value tied up in just a handful of companies. The QQ isn't broken. Let's be clear about that. But it's no longer operating in the perfect macro backdrop it enjoyed for the last year. The environment is now more selective. The rising tide isn't lifting all boats equally anymore. So, what's our strategy going forward? We do not predict. We position. Here are 4 simple ideas. First, rebalance. If your tech allocation has grown to be a much larger part of your portfolio than you originally planned, it might be time to trim it back to your target weights. This isn't about market timing, it's about risk management. Second, upgrade the quality within your portfolio. In this environment, you want to favor companies with strong balance sheets, real pricing power, stable domestic revenue streams, and consistent free cash flow. These are the businesses that can weather a storm. Third, avoid fragility. This means being cautious with over-leveraged cyclical companies, stocks that are purely multiple expansion, plays without strong fundamental growth, and companies that are overly dependent on government policies like tariff protection. And fourth, keep your optionality. Cash is not laziness. In times like these, cash is optionality. Policy-driven volatility creates opportunity. But you can only seize those opportunities if you have the liquidity, the dry powder, to act. To summarize all this in a way I think Charlie Munger would appreciate. When inflation is sticky and tariffs are a political football, you don't try to guess the next headline. You ask a simpler question. Does this business still make money if the environment stays messy for a while? Charlie once said, "We don't have to be smarter than the rest. We have to be more disciplined than the rest." This is a discipline phase, not a panic phase. It's a time to reduce fragility in your portfolio, own strength, and do your best to ignore the daily drama. And then, let time do the heavy lifting for you. As always, this is for educational purposes only and not financial advice. Thanks for watching.